Hi everyone, Nathan Stasky here. Thank you so much for joining us. Today we're going to review economic insights. Right now we see growth in inflation is expected to slow here in 2024. Supply chains are mostly healed up at this point, meaning further slowing inflation will likely coincide with slowing demand and a slowing in the economic growth. The last mile for the Fed's inflation target will be harder than some expect. We are seeing resistance in wage growth, which is good for the consumer and good for growth, but bad if you want to lower inflation. So for the consumer, they hung in there. In 2023, we had a great holiday season just over Christmas. We think we're going to see continued slowdown over the next few quarters as higher interest rates start to impact households. Overall, the consumer is reasonably healthy and the labor markets are still strong. It's more of a story of slowing spending than a story about insolvency. To us, it implies growth slowdown and maybe a mild recession, but not a full-blown 2008-style financial crisis. Whether we get a recession or not, our thinking about 2024 markets will be a late cycle market framework, meaning growth is above trend and it's not likely to get much better. Growth-oriented like equity risk premium and corporate bond spreads are starting to get a little narrower compared to history. What that implies is below average expected returns. In our view, that implies investors should ensure that they have enough quality into portfolios. Right now, the markets are pricing 150 basis point rate cut from the Feds here in 2024. But those rate cut expectations are filled by the equity and bond rally we saw late in the fourth quarter of 2023. If either inflation or growth end up being higher than expected, we may get fewer rate cuts than expected from the Feds. And we might give some of the fourth quarter rally back we did in late 2023. Turn to fixed income. We expect a normalization of the yield curve to be the dominant story here. Additionally, increased treasury insurance to fund the deficit also supports higher yields in the long end. To us, the short end continues to look attractive as the Fed is not expected to cut rates until later this year in 2024. Finally, we expect there to be good opportunities in the fixed income market, help pivot higher yielding parts of the market sometime during the year. But you're going to have to be flexible. Lastly, there's going to be a lot of noise coming up, and it's going to get louder and scarier and angrier as we get closer to election this November. So we encourage investors to stay focused on the long term and make sure you counsel with us, your advisors, so we can help guide you through all the noise that we expect to get pretty loud later this year. So to summarize our thoughts, as we start 2024, stay focused. Growth and inflation are expected to slow. Markets are pricing a soft landing. Stay flexible and stay invested. I wish everyone a happy new year, peaceful and prosperous.